ladies and gentlemen. This is Blake Morrow. You were listening to the Morning Edge webinar. I want to welcome you all back. I'm going to make the mics live for Chris Bear. Chris, are you there?
Yes, hi, good morning.
Hey, good morning, Chris. Hold on, I'm going to see if I can grab Mark really quick. Mark, are you there?
I'm here. Thanks a lot, Blake.
Hey, good morning, Mark. How are you?
Good.
All right, fantastic. Well, it looks like we've got everybody. Mike's work, it's perfect. And you know, I want to thank you again, Mark, for joining us. I know you were traveling in Asia. Was it Asia last month?
Yeah, I've been doing a lot of traveling. I came back from Asia. I was in Tokyo, Hong Kong, Shanghai.
Oh, great. I'd love to hear about the environment there, actually, and I just want to say thank you again for joining us. I know we communicated a couple months back, and you said, well, you know, I'm going to be traveling when I come back. It just so happens that it's perfect because the FOMC meets next week, and obviously now the market is, you know, overwhelmingly expecting the Fed to make a move. So with that being said, how is Asia? And second question would be, what are your thoughts for next week? We could just get that out of the way.
Yeah, sure. So Asia, I'd say the two big things. One, I'd say, is that the Japanese officials that I met do not seem particularly concerned about what seem to be a softness in the economy, which they think is temporary, or the low inflation, which is actually outright deflation now. They think a lot of it has to do with the measuring. So what this means, I think, for us as investors and for traders is that we should not expect BOJ action anytime soon. If they're going to expand QE, it's not going to be until further evidence mounts of persistent weakness in the economy.
That's interesting. That's interesting because so many people were expecting actually 2 months ago for the Bank of Japan actually to increase their quantitative easing efforts. So in your opinion, that measuring maybe being the problem, like a lot of people look at CPI here in the United States and you know, kind of question it as well. Same type of issue.
Yeah, but more I'd say that the problem is something like this. Japan is targeting core inflation, which for them excludes only fresh food. But once you exclude food and energy, their inflation is a bit higher. And what's interesting is that rents in the U.S. are going up. And this is one of the reasons why I think core inflation in the U.S. will be moving higher. I'm not a hyperinflation camp, but just slightly higher, partly because of rent and medical services. But in Japan, rents are falling, and it looks like more demographic factors. And so the BOJ wants to look through that as well. And you're looking at then Japanese and U.S. inflation being roughly the same levels. But the other thing I say out of my trip from Asia is that it seems to me that the farther you get away from Beijing, the worse that China looks. And what I mean by that is that Chinese officials recognize that they're in the middle of a transition. And that while here in the U.S. we might place a lot of emphasis on their GDP figures and who can believe them and whatnot, but that the Chinese themselves see their economies in transition. And this transition, I think, how they see it is from investment-led, which is also debt-led growth, to consumption. And in this environment, then, while a little bit of a weaker currency is helpful, a big depreciation of the Chinese currency would pose an obstacle to this transition. So on the Bank of Japan, I say don't expect easing until we see further or additional deterioration in the economy on a sustained basis. And in China's case, I'd say don't get so caught up in the GDP figures. You recognize that China is going through a transition, and that this transition will not require a massive depreciation of the currency. So some slippage in the RMB is likely, but not a massive depreciation.
Okay, well, you know, I wanted to bring in our, you know, obviously Chris Bear is here, and I'm so happy to have Chris here as well. Chris, did you have any questions for Mark regarding like what's happening in Asia? Because, you know, from an outsider looking in, and I know you live in Brazil, and you know I live here in the United States. You're right, we put a little, probably too much emphasis on that, but I think the transition period that the Chinese is looking for might be a little bit longer than some people outside of China believe. Chris, what do you think?
Yeah, well, I absolutely have no connection or other than secondhand news or thirdhand news regarding China, but Mark did say something that struck me with the question. It's more or less, if you feel inflation is going to start to edge up, what happens if GDP continues to languish slash point down. And that was the first thought I had when I was listening to him. I don't have any kind of insight into China other than anything that anybody else has written or read, and I think I'm pretty well read on it, but it's not like I have anything kind of new. I could say, as an offshoot to that, the Brazilian economy is really, grinding to a halt, slowly grinding. And I feel it in my own businesses here, and I feel it in my own experiences here. But that's circumstantial, that's anecdotal, not really data-wise, but data-wise also GDP here is falling off a cliff, and I think that's just a mirror image of what's happening in China.
Chris raises an interesting point about what's going on with U.S. GDP. It does look like, I use the Atlanta Fed. What the Atlanta Fed does is, you can see it, you can find it on Google, but essentially what the Atlanta Fed does is it comes with this GDP tracking. Not so much of a forecasting tool as what is the economy bringing in? What is the economy, what's it tracking based on the current string of economic data? Atlanta Fed revised down their fourth quarter GDP tracker to about 1.5%. So it does seem like we should be expecting, we are experiencing some slowdown in growth. I'd say a couple of things about the growth and how it relates to Fed policy. First, just like the Federal Reserve puts more emphasis on core inflation than headline inflation. When you're looking at GDP numbers, not all components of GDP are equivalent. And I think with the Federal Reserve, and this is what I do as an analyst, is I tend to put more emphasis on what's called final domestic demand. What this does is it measures GDP but excludes inventories, which are cyclical and not so much of an influence of monetary policy, and it also excludes net exports, which is also not so much a function of monetary policy necessarily. It could also be some other factors. But in any event, I think the Federal Reserve thinks that trend growth, and this is the level of growth without causing price pressures, is probably around 2%. So what the Federal Reserve argues is that the U.S. economy has been growing above trend. And this is a hard thing, I think, for investors of all different time frames to really take aboard, and that is, before the crisis, the U.S. would be growing around 3%, and that would be trend growth. And now, because of trend growth is really a function of labor market growth and productivity, that has really slowed down. And so what the Fed says, in essence, is growth around 2% is enough to absorb slack in the labor market. As long as slack in the labor market is being absorbed, they can feel reasonably confident that inflation pressures are going to rise. And so where we sit then is that I've been saying this, I've had two strong views all year. One is that the dollar is going to rally, and the other is that the Fed is going to raise interest rates. I still believe that. Of course, my timing leaves something to be desired, perhaps. We have had a big dollar rally since the middle of October, and I think that's what, Blake, I think that's what you were seeing as a trading range, is that as we're coming off of a 6-week trend or so, sort of back at filling and some consolidation, some corrections. But underlying this is partly the idea that even if the ECB disappointed us last week, the ECB did ease policy. And I think that by most reckoning, the Federal Reserve is going to raise interest rates next week. As an investor, as a trader, I'm trying to look past what's known and try to anticipate what's the next issue on the horizon, assuming that the December rate hike is more or less a done deal. And what strikes me is that the Federal Reserve, Fitch, the rating agency, some large investment banks like Goldman Sachs, are saying that the Federal Reserve is going to raise interest rates every other meeting next year. That'll be 4 rate hikes next year, and I think that that's a bit on the high side for me. I'd probably be 2 to 3 hikes, but there still seems to me there'll be a reasonably good chance of a hike in March. But the Fed Funds Futures is not pricing that in. And so I know some people who are, say, less bullish the dollar than myself argue that all the known information is already been discounted. We all know the Fed's going to be tightening, and we all know the ECB is loosening, and they think of Japan as easing, and that China is going to be easing. But I don't think that the markets work that way. I think that some events can be priced in. But I think in the bigger picture, the flows that we're going to decide next year, how we're going to invest our 401k plans, how corporates are going to hedge their receivables, is not discounted in current prices. And so in my big picture view, I've got the Fed raising rates a few times, ECB possibly easing more, BOJ possibly easing more later next year, and this is going to underpin the dollar. And the big picture view, I think that this dollar rally is going to last through next year, well into 2017, maybe a little bit beyond that. And before it's all over, I still think the euro is going to be falling to test its record lows, say maybe in 2000, around 85 cents or so.
That's funny that you mentioned that, because I was just going to ask you, just from a technical perspective, it doesn't look like it's over yet for the dollar run and the euro move down, and technically it does look like the completion would be down around there in that 88 cents, 84 to 88 cents. That would be really interesting to me.
I'm putting up a much longer term chart on the screen of the dollar as well, and this is the longer term dollar index chart, which is Chris, you're pointing out, technically flag wise, it looks like it's going to go a lot higher.
Yeah, and what I think I tweeted out yesterday, among all the garbage tweets I tweet, I every now and then I put something useful out there. I said that most people expect markets to move straight down and or straight up, and it's just not. It's actually not a normal functioning market that does that. It's much better to have these retraces and these backs and fills, and from what I'm looking at, I look at a monthly Euro-US dollar chart, and I just see a very nice test of last month's bearish candle, very bearish candle that broke down, and I think technically it's doing what it's supposed to do. So interesting. Mark's fundamentals coincide with what I'm seeing technically.
And Mark, just to talk a little bit about the dollar and about maybe some of the price action we've seen in the last couple of days or last week and a half. Obviously the ECB did not deliver what the market was expecting. I mean, that's obvious now when you have a 450 pip rally. I think a lot of that had to do with really poor positioning. You had the Financial Times that tweeted out the decision a little early, put prices up about 80, 85, 100 pips higher, even before the decision was made at 6:45 Eastern, and which as I try to explain to our normal listeners, that when you put price 100 pips higher than where it was, you're that much closer to larger stops, institutional stops, positions that are now more vulnerable. And so seeing a 450, 430 pip move following the ECB really wasn't too surprising for me. But a lot of traders and a lot of investors, especially people that have that same argument that you brought up, that, oh, I'm looking for the dollar to turn once the Fed raises rates. I've seen all the evidence that in the past, when the Fed raises rates, that the dollar falls. But I think what people are missing that you pointed out is that we have central banks going in two opposite directions. And I've been around for 20 years, Mark, and I know you've been around longer than me. When but when have you seen? I know, sorry, Mark, I didn't mean to that didn't come out right. But when have you seen this divergence in monetary policy ever in your times in the market?
Yeah, no, sure. We have seen times where the Bundesbank, so before the euro existed, times when the Bundesbank would raise interest rates and we in the U.S. would cut interest rates the same month. But it's very rare. And I'll give you an example. Right now the U.S. is offering on 2-year interest rates. And I look at 2-year interest rate differentials between the U.S. and Europe, because if you look at too long of interest rates, I think that you don't get as much, it's not as good of a fit. And so I find that a lot corporates, investors might be indifferent to euros versus the dollar, both very liquid currencies. And so you look at the interest rates and where the incentive structure. And back in 2011, Germany offered about 135 basis points more than the U.S. on 2-year notes. Today, the U.S. offers about 135 basis points more than Germany. So I use the interest rate differential not as a tick-by-tick guide, not on a but for a directional basis, I find in some ways I'd say it's like this, that the price of money has two dimensions. One is the price of money we know as interest rates, and the other is the foreign exchange value. And the two are related, though on any given day it's hard to know that that relationship is. Right now, and I think going forward, the premium that you get for holding dollars is just going to grow. And so for me, that's the underlying fundamental. For a lot of people, Blake, who follow you closely, I think it's important to stress that the time frame is important. I could be very bullish the dollar, but in the short run, we could have these kind of corrections. And I think that understanding one's time frame is an important part of the point of the discipline of trading. And then I see young people and new people to trading do things like they say, put on this tactical position, and it doesn't work in their favor, so they shift it from the tactical book, if you will, to a strategic book. That is, they hold on to the losers. And I think respecting one's time frame, know the time frame one's working on. And so what I try to do is I have a big picture view, bullish on the dollar. And so what I try to do then is avoid the temptation of trading against what I think is the underlying trend, which means I won't catch every move in the market the way I used to try to do, picking tops and bottoms. Now I'm just looking for opportunities to sell the euro or buy the dollar, or some version of that. And so I'm trying to play just with the underlying trend. But I do think that even if the ECB did not disappoint us last week, the market was prone to some kind of correction. And the question really was, in my mind, and trying to write this up, is just when does that correction take place? After the ECB meeting, after the U.S. jobs data, after the FOMC meeting? And I think that a lot of what's happened in the past week has released the pressure so that maybe we don't see such a big sell-off on the fact when the Fed raises interest rates. And that's the other point I'd say, and just methodologically, is that most of our lives we think of cause taking place before the effect. Makes sense. A causes B. A happens before B. But in the markets, we need to keep our heads sort of bent the other way, and that is the reason that I want to buy the dollar is because of something that's going to take place in the future. That is, the cause is going to take place after the effect. Me buying dollars is the effect, and the cause is this divergence of monetary policy. And so the markets, there's a lot of interesting things to say about the markets, but I think one of the things that they do very well, besides aggregating information, is discounting the future. And so we have times where the market does price in a certain event, and you should expect profit taking when I want to say oftentimes what I see on the institutional side is institutions are positioned for an event, they're expecting an event. When the event takes place, retail comes in and tries to react to that news as if it's really news, and not appreciating the market has already discounted it.
Those are some great points, Mark, and you know, our listeners here on the Morning Edge, especially over the last week, you know, we've been talking a lot about this, how, you know, the dollar, the buy the rumor, sell the fact that I think people were expecting following the FOMC decision. You had just mentioned that what had happened after the post-ECB has really taken that pressure off. The positioning in the market is dramatically changed. We'll probably find out this Friday from the COT data. But I think you're spot on as far as a lot of that pressure has been taken off. So now, following the FOMC meeting, we might get a little dip, but that dip is probably going to be an opportunity for those of us that are longer-term dollar bulls to take advantage of. And that's the exact messaging I've been relaying to our traders here for the last week now, because I think people were expecting that move to happen next week, but it happened last week. So, no.
That's a good point too that you raise. Is I think that what it means then is that despite no matter how much we analyze the markets and read the news and stay on top of things, that there's no substitute for disciplined risk management. Having stops, respecting them, know where you think you're wrong. And I know a lot of people in the markets, they sort of think, I think the sort of Main Street thinks of people in the market as being big egos, but I think that the people who I find to be most successful are those that can admit they're wrong without like undermining their conviction or their confidence, but admit they're wrong and get on with the right trade then. Clear their mind, clear them emotionally, and I think that the emotions are a big part of what we have to wrestle with.
Yeah, and that's some great comments regarding discipline and accountability too. I mean, we
Wait,
go ahead.
can I
Yes,
ask
please.
Mark, on a day like yesterday when you felt the strong buying pressure into the euro, do you look at a day like that and say, wow, this is an opportunity to re-up my dollar longs? Because you're getting an opportunity like that, like Blake said, the thing moved quite far, and I just thought that was an interesting opportunity for the
Yeah,
thesis.
yeah. What bothered me, Chris, about yesterday's close was I thought that after seeing the price action on last Thursday, a little correction Friday, the dip below 108 on Monday that wasn't sustained. I thought that it made sense that we test the 110 level. The close above 110.10 or something like that did disturb me, and I was afraid that we could head up towards 111 or so. It's not happening today. I'm still not sure that the correction in the euro is over, but I do see like on different sort of lazy man Elliott wave counts, it does look like some of the currencies are completing some kind of fifth wave up. And so I do think that we should be looking. I think that sort of like we say in our trading floor that try to minimize your maximum regret. And I think going into employment data, what would you want to do? What's more forgiving? If you're long dollars and the Fed hikes rates and the dollar doesn't rally, or it would be more forgivable if you're short the dollar, Fed raises interest rates, and the dollar rallies. I think that people would opt for the first one. It's much better emotionally, mentally, risk management wise, assuming that the Fed raises interest rates, the dollar rallies. It might not be sustained, but the idea is that it's easier to conceive of that and have a rationale for that than thinking that the dollar is going to sell off when the Fed raises interest rates. So, like, what can one explain to their boss or their client? Yeah, I got short the dollar even though I knew the Fed was going to raise interest rates. It's just not a convincing story.
It's a great point.
Not a convincing story, and not a very good strategy.
Hey, Mark, we're gonna about halfway through our broadcast. If you don't mind taking just a 2 or 3 minute break, I'm gonna allow people to run to the restroom if they have to. But there's a couple topics that I'd like to discuss coming back, and we do have some questions that come in from viewers. If you don't mind, do you mind taking a couple questions towards the end?
No, that'd be fine.
Okay, great. Chris wanted to talk about, he'll maybe ask you when we come back, ask you a little bit about, some of the fundamentals deteriorating here in the U.S. and maybe what that means with the Fed. And Chris, I'll let you ask the question. I'm just kind of asking your question, but I don't even know exactly what your question is. But also about crude oil and its impact in the FX market. And as you can see, I just had it on crude, and crude was just took another intraday spill, no pun intended, and you can see it actually dropping down towards trend lows. So I wanted to talk about what the impact would be in the FX, but go ahead, Chris.
Yeah. Okay. I had not a crazy theory, but a theory, an idea. The reason why we're not taking out we're not printing 3.54% on GDP. The ISM is weak to pointing down. Maybe it's because we have a different expectation. We should have a different expectation this time, and it's that if the Fed is taking out the depressions, okay. So we're not. They stepped in and they didn't allow us to go into a prolonged depression. If they're taking that point out, wouldn't that also mean that maybe by their actions they're actually taking out the bounces or the highs in things, and so that just tamps down the bounce. So we're not going to get the kind of growth because it's just a completely different environment. So it's kind of silly to expect, by this time, 6 years after a rate hike, there should be 3.5% GDP. It's just not going to happen. So that's my thinking. Maybe you could expand on that and give us the real insight into it.
No, I think you're onto something. I mean, I think that expectations for growth, I don't think we've adjusted them sufficiently yet. So what you suggest, I think, Chris, is very much along the sort of school of thought that says that we had this end of the credit cycle, and as you say, the Federal Reserve prevented, or policymakers in general prevented a complete liquidation and washout. They wanted to support prices, the market, the economy before all the excesses could be corrected. And that is one part of what might be restraining us, some parts of the economy especially. You think about business investment, you think about consumption. The interesting thing about consumption is Americans are consuming, but with very little use of revolving debt. That means without really use of credit cards so much. And so what's fueling consumption is jobs and the income associated with jobs. And for a little bit in the cycle, we've dipped into savings. But my concern really on the growth story is I agree that we should not be expecting a 3 to 4% growth on a sustained basis. And so what this means really is that growth, we should be looking for trend growth around 2%. I think Morgan Stanley, I was on a panel, chief economist Morgan Stanley said I think their forecast for next year is 1.9%, which is just what they regard as trend growth. That is a non-inflationary growth level of the U.S. economy. I think that the consumer is still, two-thirds of the U.S. economy, the consumer is still doing fine, doing okay. That is roughly stable, around 3% quarter over quarter, at an annualized pace. So that's two-thirds of the economy. Weakness and the headwinds, as you know, coming partly from a stronger dollar. But it's hard to separate. When you look at the net export function and you say, well, that's a drag on the economy, and many people who talk about the foreign exchange market blame it on the strong dollar. But I would also attribute some of it to the weakness of demand abroad. Japan had second quarter was contraction, third quarter was revised from a contraction. Europe is growing, but slowly. China is slowing down, and so the net export function or the net sales function in the U.S. has slowed, and the inventory cycle is still very important. But I think that we should be expecting fairly. There doesn't seem to be a lot of excesses in the U.S. economy, and because of the lack of excesses, I think we should expect, even though the expansion is now close to the average, maybe a little bit above average expansions, it's been a pretty slow growth expansion, and because of that, not a lot of excesses. So I think that this talk every so often about the U.S. slipping into recession, I don't see it like that. I do agree with the story, point this out, the PMI, ISM, manufacturing, it's headed down. It's actually been heading down all year. And the service sector, though, there's a real divergence between the U.S. service sector, ISM or PMIs, and the manufacturing. And the manufacturing partly is picking up the slide in oil, slide in energy prices, which is really weakening that sector as a whole. Think about employment, think about business investment, think about earnings. But generally speaking, the other parts of the economy still, outside of manufacturing, which picks up that mining and drilling activity, the economy seems to be okay. It's not spectacular, but with low productivity growth and low labor force growth, I think we're really stuck at this around this 2% number. We got to get our heads around that, because what it means, slow growth means low returns. Low returns means we should be expecting. I had a double in me. There's the power of 7. You get 7% for 10 years, and you can double your money. I was hoping there'd be another double inside me before my boss forced me to retire. I'm not sure if I can count on 7%. That seems to be quite a stretch without taking huge levels of risk. The government, you can loan money to the U.S. government and get about 2%, 2.20 on a 10-year bond. For me to get 3 times that, I have to take on quite a bit more risk. I'm not sure I'm prepared to do that.
Interesting. Well, Mark, I appreciate your answer. I'm going to, if you don't mind, I'm going to put everybody on hold for just about 2 minutes. When we come back, just so everybody can take a little bit of a break. When we come back, we'll talk about crude oil and maybe answer some questions from the audience. And once again, folks, this is Marc Chandler. He's been so kind to join us today on the Morning Edge. So, Mark, I'm going to mute your mic. Chris, I'm going to mute your mic, and I'm going to mute my own. We'll see you guys back here in 2 minutes.
Okay.
And as Mark and Chris come back really quick, looks like weekly unemployment claims, they came in a little worse than expected. They crept up to 282,000, expected at 266,000. Import prices are actually came in a little bit better than had expected at negative 0.4%, negative 8.8% was expected. Canadian National House Price Index also rose 0.3% versus 0.1% expected. That hasn't affected the dollar Canadian at all since crude oil is weak, as crude still got a little bit of a bid underneath it. Chris and Mark, are you guys back?
Back, thanks.
Okay, thank you. And Chris, are you there? I'm sure Chris will be joining us in just a moment. And as Chris is coming back, Mark, you know, one of the biggest movers that we've seen in the market has been crude oil. What do you make of this big move in crude oil? I mean, it doesn't seem like it can find a bottom, and it to me, you know, price action suggests that it's going to be moving lower. But how's that going to affect the currency market? We've seen the dollar Canadian already break out of a multi-month range. You're seeing the effects coming into the Norwegian krona. Some people still relate the Mexican peso to crude. How do you think how far can crude go? And in your thoughts, your opinion, and how is it going to affect the currency market?
You know, good question, because I think everybody's watching oil. First, I am bearish oil. I think that this is the way that OPEC is trying to squeeze out the non-OPEC producers. That's shale in the U.S., tar sands in Canada, stuff in Brazil. So I just had wrote a piece this week suggesting that a lot of people think that OPEC is dead because oil prices are falling. But in my understanding of the way the cartel works, dropping oil prices is part of the strategy, because what they're trying to do is get rid of these high-cost producers. But the thing what the Saudis have to do, or even part of Iran, all they have to do is stick like a straw in sand and up comes oil. In the U.S., we got to get out of rocks. Canada's got to get out of rocks. Brazil's got to go so far underwater that we're not sure that the technology exists right now to get to that oil that they have. And so, but I do think that these high-cost producers are going to be squeezed. Non-OPEC oil looks like it's going to fall next year. Output's going to fall next year. But OPEC itself is part of the problem. You know, the Iranians expect that the sanctions be lifted, and they're going to boost their output. And so right now the world is producing about 1.5 million to 2 million barrels a day more than it needs. That's what's going into inventories and all kinds of creative ways to stockpile the stuff. So I can see oil prices falling further. I have a trend line around the 98 lows, the 01 lows, the 08 lows. We're through that trend line now. And it tells me that where that trend line comes in now is about $49.50. That to me is the top of it. At the bottom, you tell me $25, $30 a barrel, I think that's reasonable. I think that we haven't overshot yet. And before this move is over, I think we have to expect an overshoot. I think that by the end of next year, the OPEC meeting that we have next December is going to be a bit different than this one. By that time, I think we'll see the cutbacks in non-OPEC output, and we'll see oil prices lower. And I think that at that point then, when Iranian oil is back online, when Libya has lost a lot of output, they're likely to pick up again next year as well. So I think that the output story will be there next year, driving the prices down. But next December then, we put the potential for an agreement.
So yeah, I mean, we've got more pain ahead then, especially if there's a lot of people, a lot of traders. You hear them all on CNBC. A lot of institutional guys that are trying to they're trying to dip a toe in here, but you think it's going to go lower? I mean, I personally do too. I've just said earlier this morning, crude oil in the 20s wouldn't surprise me at all. Now, more looking at price, you've got a lot of other evidence supporting the same type of drop, but how does that affect currencies? Because my like technically longer term targets in the dollar Canadian, I'm seeing in the 140s all the way up to 150s if you start looking at monthly charts. So I mean, how's that going to affect the Canadian economy? How's that going to affect Norway?
Yeah, so I look at this, and I a couple of points I make. One is that, and people are probably doing the same thing that I do, and so You look at the different correlations. You run correlation studies, all the currencies against oil, and see which one's most sensitive. And of course, the most sensitive one looks like the Russian ruble. But Canada is very sensitive as well. But I find that two things are happening, though, of course, with dollar Canada. One is, of course, a drop in oil prices, and Canada does a lot of other things besides produce oil. In fact, they import oil, some of it from the U.S. Canada is the exception to the ban on U.S. oil exports. So the U.S. does sell Canada oil, and I think they're our biggest export market for oil. But Canada also imports in the East more expensive Brent oil. So the Canada oil story is really more mixed, but the whole economy became leveraged to the high price of oil, and so that's why I think it has a unduly large effect right now. But I also show a two-year interest rate differential between the U.S. and Canada, and the Canadian dollar is also tracking that very well, the divergence. And that's the big development this week, I'd say, on Canada, is that last week, I'd say the market thought there was maybe a 15% chance that Canada could cut rates again next year, and I think the odds have increased, maybe as high as 40%. And it's not just my calculation of the odds, but it's really was in the OIS market, the overnight index swap market, where a lot of institutional investors use to try to understand what is priced into the interest rate market. But so besides Canada, Russian ruble, Norway, very sensitive to oil prices too. Norway came out, I think you said this, Norway came out with slightly higher than expected inflation. But Norwegians, and not the Norwegian central bank, which meets, I believe, next week, is not so much focused on inflation as they are on the weak growth. And so even though Norway is unlikely to cut interest rates next week, it probably is not the end of their cycle. Further weakness in Norway is likely as a result of that. And as you mentioned too, Mexican peso tied to oil. Partly, I'd say Mexico tied to oil because it produces oil, but probably more importantly is that it's seen as a proxy for emerging markets in general. So there's a lot of emerging market currencies that many of your viewers can't trade because of the restricted nature, especially East Asia, in Brazil as well, some other Latin American currencies. And so Mexico becomes a bit of a proxy on the institutional side. Cannot sell the emerging markets they want to. It becomes like a hedge for emerging markets, the proxy, because it's liquid and accessible. So Mexican pesos trading, it's well off of the record high, but I think that's where we're headed back up to. Mexico, besides the oil story, I'll tell you an interesting story, and this is why I hold off selling the peso, even though I'm bearish. When the Federal Reserve meets next week, people are expected to raise interest rates. The market is much more divided about Mexico. The weakness of the peso that you're showing on the chart shows how dramatic weakness, but the interesting thing is still Mexican inflation. So some people think without impacting inflation, Mexican central bank won't raise rates next week after the Fed. I am more agnostic about that. I see a better case for Mexico to raise interest rates, partly because the Fed and trying to keep the monetary policy in line with the Fed, so it doesn't cause big divergences later, but also just the weakness of the currency just sends a signal to the market as much as intervention does, if not more, that they don't want a chronically weak peso. But the four currencies I look at for oil, really, Canada, Mexico, Norway, and Russia.
And the ruble. Oh, okay, great. And so what I'm taking away from that is crude oil may continue to weaken, but some of these currencies might be getting a little. They might be a little stretched, and even maybe the Canadian dollar as well. Except the Bank of Canada poll he talked about the possibility of negative interest rates this week, if I'm not mistaken.
But no, you're right. He mentioned negative rates as a contingency plan. If he basically says, look, we think we're doing the right thing here with monetary policy, but if things get worse, there's other options we can do. And among those options he mentioned was QE, which we're all familiar with, and also negative interest rates. Segue too, I think, when thinking again about Federal Reserve, what the Federal Reserve could do. I haven't been able to verify this. No one I've talked to could confirm it. But I've heard talk that when the Federal Reserve does its next stress test on U.S. banks, it will consider a scenario of negative interest rates. And what this tells me is that despite what policymakers say about the benefits of QE, what Europe has shown us is negative interest rates. They've unveiled this tool that even the Bank of Japan never used during the lost decades of steep deflation. U.S. might have thought about it, but of course we didn't do that. The Europeans to show us negative interest rates, and the ECB's negative 30 basis point deposit rate might not be the bottom of it. You know, today the Swiss National Bank left their target unchanged, minus 75 basis points. So there's more room to go on negative interest rates, but it's just interesting that all those Bank of Canada suggesting that as a possibility if they need to, they can go to negative interest rates and start QE. And the bet, though, of course, is they're not going to need to.
Wow, that's isn't it wild to take a step back, Mark, and think about where we were at 10 years ago and imagine where we're at today, and to see what central banks are doing. I'm sure it floors me, and I'm sure it probably does to you too.
Yeah, you know, maybe it's because I'm later in my career, but it's hard for me to really get my head around negative interest rates. I mean, right now you want to protect your money, so you lend it to the German government, and they charge you almost 40 basis points to hold on to your money for 2 years. That's a privilege.
Yeah.
It's mind-boggling what it really means.
Wait, could I ask a question?
Yeah, please.
Mark, I have a little bit of an idea on the oil thing. I have a feeling that they can't really let it go much below 30, and I shouldn't say much below 30, much below 40 even. I think it's just wiping it, too many industries out, and I look at the chart and I look at the 2009 low, and I see us down there, right there, and then I look at the 2004 breakout, and then I think of the world economy from then to now, and I think that the world economy, all things considered, the world economy is still in a better condition and a better place than it was in that time. China's grown, even in Brazil. As bad as things are here, listen, it's still, I mean, we've got internet, we've got first-class hotels, there's many things here that has changed a lot. So when I think about that, I just see a bounce coming in oil that's going to, it just wouldn't surprise me to see oil above 50, but below 60, because I think 60 is right around the point where Saudi Arabia, I read your piece and I loved it, by the way, right around the price where Saudi Arabia can control and still keep everybody out of business. Because I think if it lives down in below 30, it's just going to destroy, I mean, literally, almost destroy the industry.
Can I add just a little bit to that, Chris? I mean, but I don't think we can look at it as this is where we're at in 2004, this is where we're at in 2009, because technology has changed a lot, production has changed so much, and with North American emergence in fracking, hasn't that changed the dynamic, Mark? I mean, your opinion?
Yeah, I don't know. I mean, I'm sort of thinking that we're producing a lot of this stuff. We can produce it a lot of not only in the U.S. but Canada as well. Almost constant improvements in productivity, which lowers the unit costs.
Right.
But at the same time, I sort of struck by what Chris is saying, that a much further drop in oil will harm many sectors, and I believe that. But I sort of want to say, so what? I kind of think that the market's used sometimes to hurt most of the people, and like we saw last Thursday. And I think that that's what I think that we should anticipate. The problem that I have with the drop in oil prices is not so much that it hurts some of the large producers, because a lot of the large companies have refining capacity, and that's who's making money now. They're buying the cheap oil, they're refining it, and can charge more for the finished good. That gap is making the refiners money, which the large oil companies have both refining and oil capacity. But for me, the bigger problem is what's this going to mean for our children or maybe our grandchildren. A lower price of oil means that, it means that I'm the only one on my block driving a Prius. It means that people, I mean, look at the U.S. auto sales numbers. This is really a strong part of the U.S. economy. I think we've had 3 months now of more than 18 million units sold, annualized pace. very strong auto sales numbers. It could be a record year for U.S. auto sales, and part of it, besides being fueled by cheap credit, is also being enticed by low oil prices, low gasoline prices. And so I worry about being weaned off of a carbon economy. I know that, with the global warming issues, the Paris Summit, a lot of countries are going to be cutting back on oil and carbon, but the low price of oil makes it difficult to do. And so that's what bothers me, in that the social ramifications of it, but that more pain will be felt by the oil producers. Most industries, the manufacturing industries, are oil consumers. They should benefit, and I think that's, for me, one of the things I've learned this year is that the drop in oil prices doesn't really boost necessarily consumption. It's not necessarily a unalloyed good for the economy as it's measured, but disposable income, that is, the less money it takes to fill a car with gasoline, the more money you have to spend on other things, and that's what's going on. So in some ways, I want to say the drop in oil prices is acted almost like a global QE, if you will, in easing, not for all countries, especially those that are oil producers are getting squeezed, but for all the oil consumers in the world. It's been a tailwind, not a headwind.
Yeah, definitely a swoon. Hey, Mark, I got a couple questions that I'd like to see if we can get through in the next chew through in the next 10 minutes. I got really savvy young trader, manages some money. He's been a long-time listener here. His name's Barry. He says, this is for Mark. How does your probability of, he's asked two questions actually. How does your probability of rate hikes next compare to Bloomberg's WIRP function, which is the world interest rate, I think is what it is, WIRP if I'm not mistaken. And then his second question was, recent credit market weakness and an overly strong dollar are the major arguments against no December rate hike. Does the recent dollar weakness pretty much seal the deal for a rate hike next week, or have credit markets stolen the spotlight? A couple questions.
Yeah, sure. Both questions are very good. And so some of you use those Bloomberg calculations, WIRP. I want to point out that here's what the challenge is. We all know where Fed funds are averaging right now. They're averaging around the middle of the Fed's range, which is 0 to 25 basis points. It's been averaging around 13 basis points. The key issue when you look at the Fed funds futures, and which is what Bloomberg uses on WIRP to understand to try to give some probability of Fed moves, is where will Fed funds average after they raise rates? This is a key question because this is what the Fed funds futures contract settled on. The average for the month. Not the policy rate, but the average. This is the first cycle that we've had a range of Fed funds, 0 to 25 basis points. Next, when they hike, it'll be most likely 25 to 50 basis points.
Right.
We've never had this experience before. So Bloomberg is taking the neutral assumption that we average in the middle of the range. But because the Federal Reserve is going to be using interest on reserves as part of the tool of managing policy when they begin raising interest rates, that interest on reserves is set at the top end of the Fed funds range. And I think to maximize the control, it will provide sufficient liquidity to keep the Fed funds rate slightly below the midpoint. And so if you look at the WIRP page, there's about a 78% chance the Fed hikes rates in December and next week. But the surveys, Wall Street Journal, as well as Reuters, roughly 90% confidence the Fed's going to raise interest rates next week. How do you reconcile the two? Assume then that the Fed funds will average a little bit lower. Say they average 31 basis points instead of 37.5. That would mean that the December contract's fully pricing it in. So I tend to be skeptical of these WIRP page because of the assumption, but you can calculate it yourself. It's very straightforward. The Chicago Board of Trade and the Chicago Mercantile Exchange provide some great white papers explaining how to use their Fed funds contracts. Second, I want to say the question was about Fed raising interest rates in the case that a strong dollar may prevent the Fed from raising interest rates. Now the dollar is weakened, likely to raise rates. I think that this is how I think about it. The Federal Reserve has a policy-making equation. And in that equation, there might be 4 or 5 variables. The dollar typically gets a low weighting, unless it moves a lot, which is what happened earlier this year, especially in the first quarter. And that's really when the euro made its lows back in March. And so I think under most normal circumstances, the Fed doesn't put a lot of weight on the dollar's exchange rate to influence monetary policy. It might be putting a little bit more weight on it now, but the Federal Reserve sees this as transitory. That is, the impact on the economy takes place one year, the dollar goes up 10%. And it stays at that level, say the second year, doesn't change. It drops out of it, having a big effect on earnings and trade and inflation, when it drops out of the base effect, if you will. And so the Federal Reserve views the dollar's appreciation as partly anticipating the Fed rate hike and partly a transitory phenomenon. So bottom line here, I think that for some people who might have doubted the Fed would raise interest rates next week, the fact that the dollar has pulled back helps boost their confidence the Fed can raise interest rates. In my mind, it doesn't really make too much of a difference.
Got it. Okay, great. And now another question comes in from Dan. It says, question for Mark. The U.S. dollar seems to have priced in a rate hike, but equities may not have. Is it possible next week, if we get a hike, we could see a risk, I think he meant risk-off environment, causing maybe some dollar strength against the commodity block, but see weakness against the euro and yen? So I think he's asking a couple questions about how equities might respond, and will we see a little bit of risk-off there?
Yeah, no, it's a good question, because I think that the Federal Reserve makes the announcement. This ends the liquid trading for the year. It's over. I see this in a lot of our institutional clients. This is the last thing they're waiting for when people take vacations. And those last 2 weeks of the year, I try to lose more money those last 2 weeks of the year than I lose in the first 50 weeks. The markets are less liquid. There's a little issue like we saw yesterday, the euro going above the 110 area, where they pull back the 3/4 cent here today. So I can't see the case that stocks sell off on it, but a lot of, I think that when the Fed does raise rates, it's going to be one of the least kept surprises or secrets in the world. And so I can't really get I mean, partly I want to know what happens a day or 2 days before the Fed. I won't look for a major trend change or reversal just on the Fed move. It's also hard for me to accept the idea that one market will know something and another market doesn't. And a lot of things that influence prices, and it's hard to know for me how much is price in the stock market versus the bond market. Generally, what I find is that, especially among my clients on the institutional side, the same clients that are trading the dollar are also those trading the bonds and trading the equities. And so it's like one big capital market. They can move at different speeds. I think that the stock market is chopping around. We're a very mature market after 6 years of stock market rally, and the valuations might be a bit stretched. That's what the Federal Reserve says. So some the Federal Reserve itself is not really concerned about some modest pullback in the stock market, whether it's 5% or something, as long as it's fairly orderly. Doesn't take place in 1 hour.
We lost you a little bit in the last few seconds of your answer, Mark. Sorry about that.
Sure, sorry. I was just saying that the Federal Reserve seems to view the stock market as a little bit elevated on a valuation basis, and some pullback in the stock market, as long as it's orderly, probably will not be too disruptive for the Federal Reserve.
Got it. Okay. Now, one other question, if you don't mind. Esther writes in, what do you think of the economy 2 years from now? Now that Fed's raising rates in preparation, should we be in preparation for a recession to come? Do you think? Is there a recession coming because the Fed's raising rates a couple years from now?
It's a good question. I think what's going to happen 2 years from now? I should tell you that I don't even know what I'm eating for dinner tonight. The economy is going to be 2 years, but I do respect the idea that business cycles, that we are in a cycle. We haven't repealed the business cycle. I wonder if we still are in what historians may later call still the Great Moderation. You know, it's sort of like asking Mrs. Lincoln how'd she like the play. If you ignore the 08-09, the deep recession, economic contraction, then we still seem to be in a very moderate, like a growth, like the Great Moderation. We have modest growth, not high levels, not very low levels. And it's just sort of steady as she goes. But it does concern me that we get a new president in the United States. We get the election next November. They take their office January 2017. Uh, and then I can see a recession or a slower growth, maybe it's a minor recession, before the end of the first half of the term. So say between 2017, 2019, something like that. Look what's happening. You know, some of the purchases, say, of autos are bringing forward what people might have done a couple of years from now, maybe because of low costs, maybe low cheap gasoline. They're bringing forward things, and some of that pent-up consumption will be met. I also worry about some of the other excesses that will be produced for the next 2 years if the economy continues to grow. Fed tightening, what does that do? I say, yeah, sure. I think that the U.S. economy is such that the first couple of hikes are not going to derail the economy, especially if other central banks are providing liquidity. If those other economies begin strengthening, that will help elongate the U.S. expansion cycle. So, like I say, I'm not very good at figuring out where the economy is going to be 2 years out. I do respect the idea that we'll maybe slow down further, a little bit of a contraction perhaps, as business cycles don't last forever. I'm not so sure that we want to say the Fed's going to kill it, especially as they haven't raised interest rates. In the first couple of rate hikes, I think we should anticipate to be small, gradual, and well absorbed by the market.
All right. Well, it's a great answer. Even if you can't figure out what you're going to have for dinner tonight, Mark. Hey, I want to thank you so much for being here, Chris. Any final comments for Marc Chandler?
No, just thanks as always. It was wonderful, and I'd really like to flesh out the oil thing because I think that's a big driver. So I'll be tweeting to you and to you, Blake, to discuss that more. I think it's a really interesting topic.
And Mark, I want to thank you for your gracious appearance here on the Wise Trade webinars. To spend an hour with you. The Marc Chandler, we really appreciate it. I know each and every one of our traders have gotten a lot out of this. We will have a recording for you. Ziggy, who is he's one of our traders, he just makes recordings. He's going to be posting a recording of this broadcast later. Thank you so much, and we really appreciate your time. Once again, I'd love to have you on sometime in the future.
And I appreciate the support you guys give me, both Blake, you, and Chris. I appreciate it, and something I can do, just feel free to tweet, and I'll be writing about oil for you, Chris, as well.
Thanks, Mark. Thank you.
And I wanted to mention, for those of you that don't follow Marc Chandler on Twitter, he is Mark Making Sense of the Dollar, and you should get his book too, by the way. I bought it before he came on for the very first time. It's a wonderful read, and everybody should get it. So for Christmas. They need it for Christmas or the holidays. Thanks, Mark. Thanks again for being here, and have a great day. Chris Bayer, thank you so much for being here as well.
Thanks, my pleasure.
All right, and we should have Kip Cohen here joining us at the moment. Yes. Kip, are you around? Hey, Kip.
Hey.
Good morning. How are you?
I'm good. Enjoyed listening.
What a great interview with Marc Chandler and Chris Bayer, of course. I love having Chris on as always. But what a great interview. Well, did you get any takeaways from that?